questions and answers, get to know the people in the room a little bit, just to make sure that everybody gets as much out of the webinar as possible. I'm going to go over the January effect. I think it's very important. You should be able to see my chart now. Edmund, how's that look there on your side? Great, thank you. All right, so a few things before we begin. Remember that trading is risky. If you're new to trading, just understand that you can make a lot of money, obviously, but you can also lose a lot of money. Some of you in the room here probably have a little bit of experience with trading, so just be aware that there are risks involved with trading. Now, what you're seeing here on the screen is the scalper software, and the scalper software has been a program and a software that has been very strong, very popular, and it's usually used on a 1-minute chart, but you can use it on different types of charts. So I'm going to show you a few of the software that we offer, and like I said, I want to focus the program on the January effect. I actually want to teach you this method and to prepare on what's to come in 2022. So I think this will be a good webinar for everybody. So the signals that you're seeing here, for those of you who are asking, is the E-mini S&P. It's a 1-minute chart. This is pre-market, before the market opens, and usually the way that I look at it is if we have enough activity of volatility to trade, then the signal should be fine because it's based on price action. We don't use any type of indicator, so we really stay away from MACDs and moving averages and all those things that you've probably seen and used. We really try to avoid all those things. Instead, it's price, it's time, it's whether the market is moving and has volatility. And so down here in this little blue line here, this is called the ATR. For those of you who don't know the average true range, there's a lot of videos that I have that I mention this little indicator here. I consider it more of a tool. And what happens is whether or not the market is slow or fast, it helps me decipher what to expect. So for example, pre-market, you can see the market is a little bit slower, about 1.5 points, because you can see here that the ATR here shows me this value at any point in time. So that means each candle moving into the future can move 1 point, 1 point, 1 point. And so this is my expectation as far as movement is concerned. Not necessarily a buy or a sell, it's the distance the market's going to move. Now as the market opens, as you can see, here we are live where 9:30 Eastern Time, New York time, that's my time zone. Right over here is when the market opens. You can see that everybody buys and sells and is thrown into the market, which increases the transactions, the volatility, and that's the reason why this here is increasing. And so now, moving forward in time, every candle moving forward could go up or down, right? So it's not direction based, it's just how large the candles are, will be roughly about 3.5 points, 3 3/4 of a point, and that is roughly 16 ticks, 15 ticks on average, moving forward into the future. So at least we know as traders what to expect. Is the market slow? Is it fast? Will the market make the target that I want, and what kind of stop that I want to have? So these are all things that we focus on, not just taking the same stop and the same target on every single situation that arises. We do have to adjust and understand markets are slow, they're fast, sometimes they don't go anywhere, they don't do anything, and so this helps me with this. Anyone have any questions? Just a brief understanding of how I use and look at the market, not focusing so much on indicators, but really looking at the conditions that exist and then taking it from there. So this is the Trade Scalper. If you want to look at the Blueprint software, Blueprint program is a program that we've had in mentorship for a while, and it was always done manually, but now I have it programmed as software. So I'm just going to remove here the Trade Scalper. I'm going to add here the Blueprint, which is right over here, and we'll see what that looks like. Okay, so the Blueprint creates these shaded boxes, and once the market moves away from these shaded areas, there's an opportunity. But the problem is it's not just moving away from the boxes. There's another element involved, which is, again, focusing on price action, its distance, and its time. So in the back end of the software here, we have just two options. I made this as simple as possible. Here, the two options are, let me just push this out of the way, would be how much distance does the market have to move from where the shaded areas happen to be, and how many candles, which is time-based or transactional based, or proof. This is the proof that I'm requiring for the market to give me a signal, do I need. So the defaulted setting is 1.5 and 2 consecutive bars. And what that means, give you a little bit of an explanation. What that means is that before there's a signal, there has to be a limit on how far away the signal is generated from the shaded area. So that's the maximum distance, and how many consecutive bars. So you see here, I have 1.5 times the distance from the box, and I have 2 consecutive bars. And I click apply, and you can see here that there's a signal here to go short, because this, and it has a little arrow there, this little candle here, this doji looking candle right here, is less than 1.5 times the distance, and it's 2 candles away, or maximum of 2 consecutive candles away. And so that's why that signal exists. So it shouldn't be a surprise, and you should be expecting it to occur. It's not necessarily all black box where you're not really understanding how this works. So I think it's important for you to have an understanding of how the method is generating these signals, so you can prepare yourself. Again, the same thing from this shaded area. This happens to be the second consecutive candle within a certain distance. And again, here is the most recent, if I look at this right here, here is the most recent signal. This generated box here in red, and it's now the market is beginning to push further and further away from this box. Now when this candle closes, unless it closes closer to where this shaded box is going to be, a signal will not be generated. So you won't see a signal, because if this is more than 1.5 times the distance, the signal will not be generated. It's considered overbought or oversold. If this comes down, whether it's red or whether it's green or a doji, it's just the closing price. It would be 2 consecutive candles, not more than 1.5 times the distance. So now this candle closed, and you don't see a signal. And the reason for that is because it's too far away. It's considering a little bit risky, too risky to trade. And just to give you another understanding of that, if I change that to, let's say, I want a maximum of 3 times the distance, right? So I'm not sure if that would even make it, but if I clicked apply here, you see more signals, but the signals are, since they're further away, they happen to be riskier. So I made this 3 times the distance, and so from this shaded area, you see a signal there. From this shaded area, you see a signal there. Even so, even me adding this at 3 times the distance, this is still considered too far away. So this maximum distance multiplier is very important. I don't think that the signals shouldn't be more than 1.5 times the distance. I think at that point you should consider it overbought or oversold. But at this point here, if I had this, for example, make this a 6, means it's 6 times the distance, and still it's not giving you a signal. It's too far away. So that would be the blueprint as you see it here, and the blueprint is versatile. It's not just minute or Renko charts or second charts, for example, 30-second charts. You can actually use it as a swing trader. So as an example, I haven't seen this morning, but if I put this on for example, a 30-minute chart, and a 30-minute chart would look like this. So here we have the most recent signal. Here is the shaded area. There's nothing. There's a shaded area. There's nothing. Now there's a shaded area, and this here is a signal to go short. Now this signal was a losing trade. It happened right as the market opened. I'm not a big fan, if you've seen the videos, of me entering right as the market opens. So I would definitely wait on any trade that occurs right as the bell rings. I think it's a situation that we don't really know too much about, what's going to happen as all the orders hit. So this would be the most recent signal. As you can see, this signal did not occur, and I believe, or didn't work, because I believe that it was right at the market open, is not a place where we should be as traders. If I come back here a little bit, these are the signals that you're seeing overnight. Short, here, long, long, long. Let me just adjust that, and so on. If I go back here to yesterday, add a couple more. More days on the chart, so you can see a little bit more to it. This is another signal here, another signal there, and so on. So you can see there's no magical sauce to anything that comes to mind when I see these signals. It's just, here is a situation where I want to take a trade. Does it fit within those parameters? And then I want to buy or sell, and it's completely mechanical, which is important because we don't want to continually change the way we trade or optimize or do this or do that differently every day. We just want to follow the signals as they are. Okay. All right, so we're going to now get into the January effect. So what I'm going to do here is remove everything off the chart. Does anyone have any questions for me, by the way? Either on the trade scalper or the blueprint? Yes, the next mentorship class is starting today, and we have a new mentorship class, the next date, starting on the 27th, on Monday the 27th. So the current class, the new class, begins today, and then the upcoming class, which is the last class of the year, will be on the 27th. And we do include all the software and 8 weeks of live training recorded for on-demand playback. So we do try to make this an all-inclusive program. That's correct. All right, so when I look at here, let me just remove the blueprint. When I look at the market in a bigger picture, the bigger picture usually means what on day to day or month to month the market is doing. So let me just switch here to a daily chart. And what we see here is the market retracing and then coming back up. So this is an opportunity to buy. But where do we buy? How do we buy? Or how does this all work when it comes to identifying should we be buyers or not, right? Specifically, why am I even buying the market? At what price? So all these questions, they need to be answered before just jumping in because it looks like or it could be. And again, as you can see, there's no MACDs, there's no bands, there's no multiple moving averages. I'm not looking at crossovers or stochastics, momentum, anything that you have probably seen or tried. I don't use any of those things when I teach traders how to understand price action. I really just want to focus on what we're seeing here at the moment. With the January effect, this is done every single year, and believe it or not, it is 85%, 90% accurate through many, many years. The way this works, and I encourage you to go back in history, it's very easy to do as well, to go back in history and to look for yourself, see for yourself, and what I'm going to show you, see if it works and if there's an opportunity there that you can take as a trader. So if I look here at January of 2021, we look at the month as a whole. Was it a month that had a higher close? Did the market go up? Was February's open higher than where it began? If you look at those things, it tells you a lot on what to expect throughout the year. So the January effect is something that a lot of professional traders look at and hedge funds look at, because if the month of January is a higher month, meaning it started and then it ended higher, typically the year will be higher, and that's where 90% of this accuracy comes from. It's just looking at January. I'm going to actually try to add some more data here. And the idea when you look at this is to say, since the year will most likely move higher, trend higher, move higher, how can I take advantage of that? And you can take advantage of it, and there's a few ways that you can take advantage of it. So the video I put out yesterday, based on it continuing to, and if you haven't seen it, you can go ahead and take a look. I'm going to go over that same information here today. If you look at here January and February, and we realize that this is a higher month, which means it started here, right? And then here is February 1st. Just slightly, I think it was about 20 points or so, it was a higher close. So we're trying to be as specific as possible. A higher close, higher month, the market moves higher at the beginning of February 1st. And so this puts into effect whether or not we should more often than not look for buying opportunities. So one of the methods is every time the market breaks higher from a previous high, we have an opportunity to buy. And so you can see that as we move into, so this is February, just to outline this here. This is February, this is January 2021, this year. As soon as the market made these highs in January, and because it was a higher moving month here, as soon as the market breaks the highs of January, in February, I want to buy the market. And it could be by a point or two, it could be by, you can have a stop order, a stopwood limit. And the idea behind it is that there's a pop or an explosion or a momentum move type of idea that as soon as it breaks the highs, it's going to move a little bit higher. Now I don't know, and I can't say for certain it's going to move this entire distance. So this is not something that I can say expect it to go 87 points. It's not at all what I'm after. I'm after an opportunity to get into the market and then begin to trail a stop. As long as I have the direction on my side, I'm accurate with the direction, I can then manage the trade much better. Instead of guessing the direction and hoping it's going to go in my favor, I know that the market's going to move higher once it breaks the highs of the previous month. And so it did. And at this point, again, trailing a stop is something I teach in mentorship. We teach in mentorship, and it's also there are a couple of videos out there explaining a little bit on how I trail a stop using multiple contracts. That's not something I'm going to get into today, but trailing a stop, however you'd like to do it, or if you have any of the programs we offer which explain to you the trailing stop parameters, take advantage of it. Trailing a stop is great under these larger moves. Does anyone have any questions so far? Edmund, Sally, Jesse, Peter, Charles. So now, as the market in February makes new highs, we have now a different option to look at. We look at the highs in February and we wait until these highs are broken. It doesn't necessarily need to be in March or April or May, but at some point the market will get back up to these highs and continue through them and break them. Now when that happens, again, the one thing that I've noticed over the years is that markets like to test where they've been. So if you put that into terms that we can understand, double tops, double bottoms, markets like to test those areas. So I'm not necessarily looking to buy at the exact high here that the market made in February. I want it to surpass it and go through it, and then by a few points go long. So remember, markets like to test where they've been, and therefore I'm not interested in going long right at that high or right in front of that high. I want to go long after it breaks through it. So this here would be another opportunity. If this price is 39.29, I would say 39.33 as an opportunity to be a buyer, just so it surpasses it by a few points. And there it happened in March. And you can do this month after month if it happens. Again, if March doesn't come back and break the highs, this high is still in place. So whether it breaks it in April or May or June, we're still looking at that as an opportunity whenever it happens throughout the year. It just so happens that it's happening month after month. Now, this method of trading is very simple. You do have to have, I think, a little bit larger of a stop, and that's where we take a look at the ATR. I also think that if you enter long and the market goes up and then closes back below, that's an opportunity to say, let me get out of the trade. and I don't want to hold on to this, or if your trailing stop kicks in and then you get stopped out with the trailing stop. But we really don't want the market to come back down below where the highs have been. We want it to continue higher. So that's really the idea. And if it does, remember to get out of the trade. Don't hold on to these trades if they become if they continue to go against you. We want to get out as soon as possible. So this is now April, this is now May, and it's the same thing over and over again. June, right? We have a new high and the high is broken. We have a new high made in June, it's broken in July. We have a new high in July, it's broken in August, right? So you can see that continually, it just so happens that every month the market just keeps on providing us an opportunity to go higher and higher. So that being said, we're looking at trades that don't happen quite that often, but they're good trades. And this is, again, more investing or swing trading for some of you who want to do that type of trading as opposed to day trading. Now here we have a different situation where in August the market made a huge move to the downside. In September the market made a huge move to the downside. Here is October, and then it started the climb back up. So the first way that I like to trade this method with the January effect is when it breaks the highs. But there's also another method which I think offers a different opportunity, which is what if we look at these retracements that occur, putting rules to them, and then seeing if we have an opportunity, since the markets like to test where they've been, have an opportunity to go long. So I'm only focusing on long trades. This does not work in the reverse with sells. It's only for long trades. What if I am able to go long leading up to the highs?
If you're new to day trading and want to learn more on the benefits of trading the markets, visit DayTradeToWin.com, join the next mentorship class starting later this month, and subscribe to the Day Trade to Win YouTube channel. We focus on price action and work exclusively with new and beginner traders who want to learn more on how to prosper from trading.